Today, you're going to hear the best 2 companies that you can invest for the super long term. And since we have so much to cover for today, I'll skip the intro video and give it to you right away. Number 2 on our list is a company that's associated with the GOAT of investing. This company has delivered 59,693% return over the last 40 years. Of course, it's outperformed S&P 500 by such a wide margin that is laughable. This company is none other than Berkshire Hathaway. Berkshire Hathaway has seen certain stones thrown at it over the last 5 years. Because let me show you something first that really illustrates to you what goes on behind active investments. Take a look at this 5-year chart. You realize that Berkshire Hathaway has underperformed S&P 500, correct? Ever since 2019 to 2022. You see that yellow line S&P 500 outperformed Berkshire Hathaway by so much. That is why people started to call Warren Buffett out of touch, etc, etc. There are new Warren Buffetts on the market like Cathie Woods and stuff. But little did we know the new Warren Buffett was actually still Warren Buffett. Warren Buffett's Berkshire Hathaway has now since caught up with S&P 500 and outperformed it. And it really reinforces the point. When you want to do active investments, there are going to be periods whereby you underperform and you have self-doubt. But always take the slow and steady approach and look long term. With that cleared, let me take you back on a trip to learn some things in the years before the dot-com crash in year 2020. This is actually by Pie Chart Pirate, which illustrates to you what had happened in 1999 and 1998. Take note again, in the preceding few years, the market was hot. You see that in 1998, Berkshire Hathaway started to build up some cash, correct? That reinforces to you that it's important to keep cash, especially in a bull market, because after bull market is a bear market. So never go all in bull markets. However, you will also see that Berkshire Hathaway actually made wrong purchases. What do you realize? They have actually bought American Express in 1998 to 1999. The cash pile dropped, but American Express stake increased. Now this reinforces. It happens to everyone when you get the market timing wrong. Market timing is actually not that important at the end of the day. So what if you've gotten it wrong? You just have to probably wait longer than expected. How long did it take for American Express to reach back its prices in 1999? 6 years. So if you'd like to buy a stock today, always remember, the journey might be 6 years before you get back your monies. But if you focus on 26 years, you realize that American Express has now done a 3-bagger and rewarded long-term investors well. Then let's move on to 2016 because I have also something interesting to highlight to you in Berkshire Hathaway's history. Something magical happened, correct? This company came into place. Have you noticed it? Apple. Apple's allocation has swelled all the way to 20%, and that was before 2018. Warren Buffett actually sold out on Wells Fargo, which is on this chart still, and bought more of Apple recently. Right now, Apple is more than 30% of what Berkshire Hathaway owns, and you can see that it's the number 1 allocation by a big margin. But my personal gut feeling is Apple's valuation seems to be rich now. I don't know whether it will be the same mistake as American Express back in 1999. That's why I've actually put up that story to illustrate to you things. But hey, who am I to question the GOAT of investing, correct? Let's look further at his choices for the recent times. You realize that he has made big purchases, especially in commodities or energy space. 11.9 billion towards Occidental Petroleum and 23.8 billion towards Chevron. Some people are also taking notice of Taiwan Semiconductor, which is $4.8 billion allocation. Taiwan Semiconductor is in the semicon space. By my understanding, you can see more of them as an industrial player, supplying chips to the value chain. So why buy Berkshire Hathaway over S&P 500? Quite simply, S&P 500 as of current moment is allocated heavily towards technology. Berkshire Hathaway buys companies in many other sectors, and they are at the heartbeat of value investing. I still believe that over the very long term, this will outperform the index, and that's of course still my own interpretation. As always, anything mentioned over here should not be construed as financial advice. And a quick snapshot of what we have covered on our list of top 20 so far. In this previous tutorial, you realize the champion of their category at number 15 was actually Abbott Laboratories. Then in the subsequent sequel, you realize that from number 11 to number 14, Google was the champion of that list, coming in at number 11. Some people feel that that is way too low a rank for Google, but I have my reasons for it also. Then from the list of number 6 to number 10, you realize that Amazon was the champion of that list, coming in at number 6. On that list, you also see Johnson & Johnson, you also see Procter & Gamble, and you also see McDonald's. And I'd like to do a quick shout out to Aaron, who left a fantastic comment over there. Aaron, hopefully McDonald's does well. I have this quick clip by Peter Lynch to share with you.
It has nothing to do. McDonald's earnings go up the next 10 years, the stock will go up.
Then we go on the list of number 3 to number 5, of which Apple is the champion of that list, coming in at number 3. And as always, if you'd like to invest in any of these excellent companies, look out for a sponsor for today, who is Weibo. Now have a sign-up offer, especially for you, whereby you can get free vouchers, simply make a deposit of $2,000, perform at least one stock or ETF trade and one mutual funds trade. That in itself will get you that $50 worth of trading vouchers already. And do know also Weibo charges $0 in commission, so if you're keen, look for links below, and thank you again for supporting this channel. We've covered 19 companies already. Who is the number 1 company to invest for the super long term? I've actually been toggling between this company and Berkshire Hathaway for the number 1 position. But in the end, I decided that it is the right call. And if you stick with me to the end of this whole presentation, I'll be sharing with you my personal insights about what I feel about its current valuations right now. But without even factoring that, I think it's unanimous that we can all agree that this is a fantastic company. My criteria was previously mentioned. This company cannot be still helmed by its founder. Its current CEO took over its founders from year 2014. This company has roots both in the B2C and B2B space. And last but not least, this company has been through many wars and recessions and came out of it stronger than before. This company is none other than Microsoft. As of this time of filming, Microsoft is the 3rd biggest company in the world. And just in case you haven't seen its breakdown of revenue before, let me show you this chart over here. You realize that 31% is towards Azure, which is its cloud computing segment. I'll touch on that in a quick while. The second biggest segment is its bread and butter, which is Microsoft Office. Then at 14.43% is Windows. Windows has a monopoly on operating systems, and while we think it's boring and not cutting edge, it is actually a bedrock whereby it drives extra revenues such as its Bing search engine, such as Microsoft Surface and other different developer tools. So its significance to Microsoft cannot be understated. But let's dive back to cloud computing segment, Azure. If we see the latest market share, you realize Azure now commands 21% of total cloud market, trailing only AWS by Amazon. But if we look at history, you realize a trend. Amazon has been number 1 for the longest period of time, correct? And back in 2017, its market share was close to 40%. But right now, Amazon's market share has shrunk to 34%, and the sky blue bar over there is actually Microsoft. Microsoft has been catching up on Amazon aggressively, and current CEO Satya actually comes from the cloud computing segment. And just to understand the difference, let me quote from Grants. Research Boutique Apps has actually discovered that companies employing fewer than 100 people compose more than 1/3 of AWS's corporate roster. On the other hand, Azure does not have companies that have 100 people and less. That means Azure is actually targeting the bigger accounts. And if you were to guess, the biggest companies will likely still survive this recession, whereas the smaller SME companies may not. If we were to look in terms of revenue breakdown, this chart also shows the growing contribution of cloud services to Microsoft. The one in the middle has been growing, correct? And that is actually Azure. We can also see that Microsoft Office contribution has been shrinking over the years, and the same can be said of Microsoft Windows. However, they're actually not becoming more unprofitable. They are just growing at a way slower pace. And this screenshot over here shows you even more details. You realize that the growth of its mature segments are in single digits, whereas cloud services is growing at 28%, search advertising, which I don't understand why, is growing at 36%, and LinkedIn is growing at 34%. So speaking of LinkedIn, there's this term that Microsoft is actually the Berkshire Hathaway of technology, because it's been integrating so many tech platforms into its overall scope of services. Gary Vaynerchuk has also mentioned that LinkedIn is the best place to advertise. And just in case you didn't know, LinkedIn actually has paid advertisement portals for corporates and individuals. Just in case you want to reach me on LinkedIn, this is my profile there too. Now let's switch gears to some other things that Microsoft is trying to do, which is in gaming. The biggest headline that's coming out right now is actually Microsoft's acquisition filing of Activision. Activision is the premier gaming producer. You can see over here some of the famous names such as Diablo, Call of Duty, World of Warcraft, and Candy Crush. I haven't played too much of these games, so I only know them on the surface, but I do know that they are big hits. However, right now, Federal Trade Commission is filing to block Microsoft's acquisition of this company. Whether it's successful or not, it's up to your interpretation. But Warren Buffett has actually mentioned that he believes that it will go through, and that's why he's been buying Activision shares and terming it as an arbitrage deal. Again, I'm not too sure about that, but what I can share with you is that CEO Satya Nadella has been doubling down on Microsoft Game Pass. And the whole idea about acquiring Activision is to have 400 million more monthly active users. And if they integrate it together, realize that Microsoft will have a very powerful say in the entire gaming industry. My gut feeling on this deal is that if we see Activision's revenue cycle, you realize that there are highs and lows, and every time there is a high, it's because of a blockbuster game. It may be cheap because right now it is a low cycle, and wait till it releases a new game, you'll see that revenues start to pick up again. On the other hand, it could also be expensive because right now markets are deflating. Google, for example, is trading at less than 20 times price earnings, whereas Activision is still more than 35 times. But what I can guess is this: Microsoft has more than $107 billion in terms of cash on hand. And even if Activision's acquisition doesn't come true, it is very possible that Microsoft will pursue other targets. There are rumors that it could potentially even buy Netflix. And if it does, it could integrate video streaming into its entire suite of services. That one again is still a rumor. Now, since you start with me to here, let me share with you my thoughts on Microsoft. Currently, net income is dropping on a quarter-to-quarter basis. This is reflective of corporates cutting back on expenditure. That is why share price for Microsoft has been dropping in the last few months. Right now, Microsoft trades at about 25 times price-earnings ratio. However, I think a lot of its price appreciation has been because of the positive sentiment towards cloud computing segment. So if we were to use back a time whereby expectations were less inflated, you realize that Microsoft traded around 20 times price earnings, correct? At current earnings per share, I think an attractive price to enter Microsoft could be around $180 per share. Of course, that is still quite some way off the current share price today of 230 plus. But again, that's my assessment of things. As always, let me know your thoughts in the comment sections. Hopefully you've enjoyed this entire series of the top 20 companies. Whether you buy Microsoft at 230 or 180, I guess the consensus will be Microsoft will be worth a lot more if you were to hold 20 years. That is why in the grand scheme of things, when you look long term, it really doesn't matter what your exact entry price is. As always, invest safe, and if you'd like to check out the previous tutorials that I've covered to find gems for yourself, follow through on series and I'll see you there too. Take care and goodbye.